Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the big stories on the Bloomberg terminal today and how U.S. banks finance their own competition to the tune of $1 trillion. I'm talking about financing, providing some financing to non-financial kind of institutions. Think private equity, private credit, that kind of thing. Herman Chan joins us here. He's Bloomberg Intelligence. He covers all the banks. Herman, what are the banks, the U.S. banks, doing in terms of, lending to maybe some non-traditional financial institutions like private equity, like hedge funds? How big of a business is that?
Yeah, it's really interesting because the Federal Reserve has just recently required banks to disclose more on lending to these non-bank financial intermediaries. And what we've seen is that some banks that we cover, like Bank OZK, Western Alliance, that could basically mean over 50% of their commercial loan portfolio is to these shadow banks. So it's an area that is growing, where you see traditional businesses are a bit wary in this current macro environment with still elevated interest rates, a lot of uncertainty with the economy. But lending to non-bank financial institutions is an area of growth. Mm-hmm.
So explain shadow banks. What is that topic?
So it's interesting. The regulators have broken out shadow banks, non-bank financial institutions, as institutions like mortgage lenders, private equity, private credit, financial institutions that lend but don't have a depository component to their operations.
So I kind of view these, what do you call them, NDFIs?
Right.
So non-deposit financial institutions, aren't they competitors to the banks themselves? So why am I lending them money?
They are increasingly competitors. What we have noticed is that the participants that are borrowing from these non-bank financial competitors are a bit more riskier, and so they are viewed as more high yield, and these are areas that the traditional banking institutions don't want to lend money to. So a way to get around that is to lend to the sponsors, and that's something that's happening. What's interesting is that the banks themselves will say they're not competing with the private credit operators head to head, but we do see a bit of a hollowing out of the traditional business borrowers, because if you have private equity coming in and leveraging the balance sheets of the companies they borrow, inherently these companies are not going to be good customers for a traditional bank. So a lot of these customers continue to go away.
So I'm hearing that industry watchdogs are worried about the increase in bank loans to these NDFIs. Mm-hmm. They're thinking that it can make banks more vulnerable to liquidity or credit shocks. Mm-hmm. What have been the developments there? Yeah,
well, it remains to be seen, right? So it's continuing to be a larger and larger portion of the loan portfolio for these banks, but it's still, in the grand scheme of things, a lot of the banks remain very diversified. But we haven't seen a downturn with such a fragmented market where a lot of the lending is going outside of the traditional banking system. So it's something that continues to be monitored and something that we're assessing quarter by quarter.
Do you like this business as an analyst? Do you think it's a good business for some of these banks?
Right now, it's a way to demonstrate some better growth. We just looked at the numbers before joining, and traditional commercial and industrial lending, it's about in the first quarter, it's about 0.5 percentage point growth. If you look at the lending to non-bank financial institutions, it's up 5.7% in the quarter. So if you have a bit more exposure to that, you can juice your growth, which in this current environment, you're not seeing a lot of activity there. But again, you need to have a very diversified portfolio.
All right. Herman Chan, you're the expert here. We're going to go with you. Herman Chan, Senior Analyst for U.S. regional banks. We usually only talk to Herman when something's blowing up, but we want to
Something's
talk
going
about
crazy.
when something's going right. And here's a new source of potential loan growth for some of these banks out there. Herman Chan, Senior Analyst, covers the regional banks for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go to Steve Mann. He's a global autos analyst. Steve, I know you got earnings models out there for a lot of these big auto companies. Are you adjusting your earnings models for tariffs here? How's that going to impact some of these big global automakers?
Yeah, we are actually going through that right now. One of the things we did publish this morning was the auto sales forecast for the U.S. We were initially looking at down 0.5%. We're looking at being down at least 3% now for the year. But we are going through the model. One thing that really stood out for us was really Ford. Ford, look, they're losing arm and a leg on EV sales. The popular Mach-E is actually made in Mexico. So, like for us, if you tack on another 10 grand on the price, and it goes through the bottom line, it could hit you could hit $500 million on earnings. That's 10% of their earnings. So, those are some of the things we're looking at.
Steve, what are the names that you're seeing are most exposed here?
Well, I think on the downside are definitely the legacy, the big three autos plus the foreign legacy automakers. They do have a lot of production outside of the U.S. As you can see, the pure plays, not just Tesla, Rivian and Lucid are actually performing relatively better because there's a possibility that the pure plays could take market share, EV market share from the legacy automakers if they have to increase prices on those EV imports that they make in Mexico. The other thing that's interesting too that we're keeping an eye on is really on the retail auto parts companies like O'Reilly, AutoZone, Advanced Auto Parts. They're actually bucking the trend. They're up. And simply the reason is that, if people are not buying new cars, they're going to have to maintain existing ones. And so, those DIY part stores are actually doing well today.
Yeah, I'm looking at those stocks. AutoZone, for example, is up 2.7% today, 52-week high. A lot of the other names are up 2, 3, 4%. And Steve, I'll have you know, I did buy I leased a new vehicle this past weekend, a Honda, but I got a hybrid. So how about that?
Which Honda is this?
Okay.
CR-V.
Okay.
CR-V,
Love a
okay.
CR-V.
So I got in front of the tariffs there, so I'm all set to go there.
You're on your way there.
So, Steve, what are you hearing from the Hondas of the world, the Volkswagens, the Toyotas of the world? How are they viewing this environment?
Yeah, I think they're going to face some cost pressures as well. They do have a big chunk. Actually, the CR-V is actually made in Canada, by the way.
Oh, okay.
So they're going to.
I don't know what the big deal is.
C for Canada.
Yeah.
So they're gonna get hit, but the difference is that Honda and Toyota in the U.S. and I think globally they do have a much lower dealer inventory. So there's still a lot of demand for their cars because they're known to be more reliable. So they may be able to pass on some of the higher costs, the higher pricing, the price increases to the consumers. So they would probably fare better within the legacy automaker. But the European will probably get hit pretty bad, especially like the luxury brand BMW, Mercedes, and Audi. They have a different strategy. They don't have multiple plants for certain models. They have a global plant for their models. So for example, BMW and Mercedes makes SUVs in the U.S. So it's going to be hard for them to shift footprint. But the other way to think about it is, if someone is able to afford a more expensive vehicle like a Mercedes and BMW, they may be able to stomach the higher prices.
Yeah, I don't know.
Coming through.
My BMW X3, I guess it's South Carolina, or I don't know where it was built, but it wasn't in Stuttgart with the rest of them.
Yeah.
Steve Mann, thanks so much. Appreciate it. Steve Mann, Global Autos and Industrials Research Analyst for Bloomberg Intelligence. He's down there in a Bloomberg Princeton office. The office, probably some of the best food in all of global Bloomberg. I'll lay it out there for you right now.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Talking about the AI trade for 2 years?
It's been
I feel
a minute.
like it's not just been a tech thing, it's been a market thing. Every company in the S&P 500 in their conference calls, they talk about AI. It's been going on for a couple of years. One of the ways to think about it is from the real estate perspective.
Definitely.
Yeah, you can do that. John Lynn, he does that. He joins us. He's the Chief Business Officer for Equinix, joining us here in our Bloomberg Interactive Broker Studio. John, tell us what you guys do at Equinix.
Thanks so much for having me. We're really the fundamental digital infrastructure provider of the world, building 268 data centers across 74 markets.
So you're the guys doing it.
So we are the guys building and connecting all of these cloud providers and enterprises, making all of that data available for AI.
And it's really interesting because I was just speaking with him during the break saying that I cover U.S. real estate stocks. I cover real estate investment trusts, and that's exactly what Equinix falls in that patch.
Okay.
This is my guy.
Now it makes
So
sense.
wonderful to have this conversation. But I think that there's often, people don't really, when they think about data centers, they don't often think about the people that are actually providing the real estate for data centers. So can you talk a little bit about how Equinix differs from maybe if you're thinking about a data center itself, but more or less the fact that you guys are acquiring properties and doing it that way?
Yeah, you can think about it as full scope development, where we're going from raw land, getting their entitlements, and then building the entire data center, and then operating that for perpetuity, essentially. And our focus is around making sure we're getting as many customers as possible into the facilities and really interconnecting their data flows together, which is pretty unique in the data center space, which has also been a great opportunity for us to participate in the AI growth.
Yeah.
What are you guys seeing here? What are you seeing from your clients, the people you talk to, about kind of their needs going forward? Because right now, I think in the marketplace, if you look at like NVIDIA stock and some of the other stocks that trade around the AI theme, 2025 has not been a good year after obviously phenomenal, extraordinary growth in 23, 24, maybe even before that. How are you viewing the growth here in AI and from your end of the business, the real estate side?
Yeah, first, I'd just say, AI is a portion of the demand for data centers, but data centers as a whole are powering everything that everybody is doing, right? Like listening to this broadcast, ordering food for lunch, trading trading on the exchange, et cetera. You need computers for everything nowadays, and that's still continuing. I think, digital transformation is not in the early stages anymore, but we're far from done. And so that is just a secular driver that will continue. From the AI landscape, I'd say, obviously a huge amount of interest and excitement, and I think it caught the imagination of everyone. And I'd say right now what we're seeing is like exciting use cases that are really providing durable value, right? And I think it's still early stages for many of that across the general business landscape, but that's what gets me fundamentally excited. You look at a company like Bristol Myers Squibb, a customer of ours, they're doing drug discovery using NVIDIA GPUs, and like being able to increase and accelerate their time to therapeutics, that's fundamentally going to improve like human life, right? And I think that there's so many different aspects that AI can improve based on that.
So run us through some of your biggest customers. Who do you all work with?
Certainly the cloud providers are some of our top customers. We've got over 2,000 different network providers as well. The genesis of the company was really around how do we help the internet scale? And that ended up being, well, how do we help the globe's telecommunications and data flows scale? And so when you think about all of the cloud providers, how do they connect to the end customers? That's through our facilities. And then as we've built that landscape, we've ended up basically becoming the place where enterprises put their most trusted assets. When you think about then when they have some workloads that are in the public cloud, well, they're going to have some that they're going to have ownership and control of themselves. When they put those in our facilities, it lets them glue that infrastructure together and become like one super powerful environment.
And folks, Equinix is a publicly traded company. EQIX is the ticker. It's got a market cap of $81 billion. And if you want some research on it and you're on the Bloomberg terminal, Jeffrey Langbaum is my REIT analyst. He covers EQIX, so you can go to BIGO, and that's where you'll find the research on Equinix. John, talk to us about the global footprint. We know you guys are global here. Where are you seeing growth, stronger growth versus weaker growth?
Yeah, I'd say across the landscape, there's still quite a bit of demand for data center activity. We're particularly excited about some of the emerging markets. Southeast Asia, for instance, is certainly growing quite a bit. But, based off of a lot of the recent surge in AI and kind of the use cases set up for that, just a tremendous amount of growth in the U.S. over the course of the last 2 years.
So, when we think about your competitors in this broader landscape, there's obviously Digital Realty Trust when we're thinking about publicly traded REITs here in the data center space. And if you look over the past 5 years, we have Equinix shares that have risen 40%, but that's compared to Digital Realty that's risen about 11%. What do you think that you all are doing differently than your competitors?
I think one, it's our focus around really driving diversity of customer and like kind of having an ecosystem that we've built around the value that we're doing. And so that's incredibly important for us. Like for the AI trade, for instance, we're focusing not just on capturing some of these large training footprints, but really how do we make sure we're getting all of these AI players and exposing them to the rest of our customer base? And really, again, that fuel becomes additional growth across our entire portfolio.
Do you develop and build data centers, or do you just buy existing ones?
We develop and build. Yeah.
Where are you developing and building these days? And if you say Texas or Florida.
Well, we're building all around the world. I think we've got 68 current major construction projects across.
Really?
Yeah, so it's we're very active.
Wow. How come I've never, well, I don't.
It's a it's a pretty big company in this space. People don't think about REITs. You guys have to come to my patch.
I know.
It's a beautiful space.
So what are your thoughts for people who are saying that, the tech rally has run too far? Maybe we have CapEx spend that's just, bloated. There's so much spending in this space. Is this a place to be investing right now when we think about AI and in places of that regard?
I think the long-term trend around this is going to be inevitable, right? I think it's certainly we're creating durable value, not just for, kind of the planet and all of our customers, but for shareholders. I think the amount of investment in the space and the numbers are candidly eye-watering right now. And so, but a lot of that I think is just capital accumulation rather than deployment. And, compared to a lot of other markets in the real estate side, it's actually a little hard to kind of overbuild just because there's so many natural limiters in terms of the way we want to scale, from utility power availability to supply chain to kind of just the amount of trades you need to be able to build and operate these facilities. And so I think that helps kind of provide more rationality than in some real estate markets where you can throw up a shell pretty easily. You can kind of just convert and overbuild. In this case, it's a very long development cycle, and so I think you'll see kind of some self-metering there.
John, thanks very much for joining us. Really appreciate you coming in. John Lin, he's a Chief Business Officer of Equinix, joining us live here in our Bloomberg Interactive Broker studio. Again, another company walking into my door here, my studio, I had no idea existed. It happens every day.
Now you know.
$80 billion in market cap. And of course, I missed it. But a big real estate investment trust. And I know our BI analyst, Jeff Langbaum, he's all over. He's got research on this company as well.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.